Hello everyone, my name is George Saradakis. I am an associate here at Vincent Hirsch Financial Services. Today we're going to be going over guide to credit and debt management overall. So let's get started. So today we're going to talk about 5 things. We're going to talk about what is debt. We're going to talk about student loans a little bit. We're going to go over some credit card basics. And we're going to go over some debt repayment strategies, and then finally we're going to wrap it up and talk about the basics of credit and the fundamentals and why it's so important. So what is debt? Debt is something owed, such as money, goods, services, etc. There are 3 components to debt: principal, APR, and term. So principal being the original amount that's borrowed. Your APR is essentially the interest that's owed on the debt, and the term length is how long do I have to repay the debt. So if I go to my friend and I say, hey, can I borrow $500 and I'll pay you back 10% in interest, I'll pay you by the end of the week. So the principal in that situation would be the $500, right? I'm asking to borrow $500. The percentage rate, the 10%, would be the interest, which is $50. I'd owe him $50 on top of the $500 that I've already borrowed, and then I owe him that money by the end of the week. So now that we've got some basics covered, let's go over student loans. So when we're talking about student loans, we first address the FAFSA. The FAFSA is an application for federal financial aid and a tool to determine our eligibility for financial aid. We're going to get into that calculation shortly. It is not an application for college, it's not an application for student loans, and it's not an application for any kind of scholarships or grants. When we calculate the FAFSA looks at a couple different variables. It looks at income from the prior year. So as we're recording this, we're in 2025. So it's not going to look at income from 2024. It's going to look at income from 2023. It's going to look at your assets. So that would be things like how much money do you have in a checking account, in your savings account, in some kind of investment accounts, your home, things like that. Your liabilities are the opposites of your assets. They're your other debts: car loans, mortgage, if you have a securities line of credit, debt, if you have credit cards, etc. Takes a look at marital status: divorced, married, single, separated, widowed. It looks at household size. So if you're a single mom with 3 kids, it takes a look at that. If you have 2 kids in college already, it also factors that into consideration. All of these sum up into what's called your student aid index. Now, the lower your student aid index score, your SAI score, the more aid you'll be eligible for. So it's an inverse relationship here. When we look at student loans, we're going to address federal student loans. We have subsidized student loans. Those student loans are such that the interest begins to accrue 6 months after the student graduates. So if I graduate in June, the interest on the debt does not start accumulating until December. Whereas unsubsidized loans, the interest begins to accrue immediately. It begins to accrue on day 1. So if I sign for my loan on August 1, the interest begins to accrue immediately on August 1. Grad Plus loans are federal student loans for graduate school. And then when we discuss repayment options, there are a bunch of different repayment options for federal student loans that are offered for flexible payment rescheduling. And that contrasts from private student loans that don't really have the same flexibility. Now, as we record this, again, I mentioned we are recording this in 2025. Earlier this year, there was some new legislation passed regarding federal student loans. There's been an implemented borrowing ceiling for undergrad loans. Undergrad loans have not really been affected by a new borrowing ceiling. Grad Plus loans, there's been a new ceiling of $20,500 per year with an aggregate lifetime limit of $100,000. But as of July 1, 2026, Grad Plus loans will be closed to new borrowers. For professional grad loans, those loans have a ceiling of $50,000 a year with an aggregate limit of $200,000. When we take a look at things like Parent Plus loans, those have a ceiling of $20,000 per student per year, with a lifetime limit of $65,000 per student, and we have a total lifetime ceiling of $257,500. There's also been restructure and just overhaul of the repayment plan options that preceded the bill, as well as an introduction to a new repayment option. The repayment option that's been introduced is called the Repayment Assistance Plan, or the RAP, and essentially what that is, it's a direct tie to one's AGI, so adjusted gross income. So as your adjusted gross income goes up or down, then your calculated student loan payment on a monthly basis will also go up or down. There's also been a phase out of some income-driven repayment plans, such as the SAVE plan. There's also been an overhaul of current income-driven repayment plans, including the SAVE and the PAYE plans. That has a final deadline of July 1, 2028. So we're going to move away from student loans, and we're going to go into the fundamentals of credit cards. Credit cards, just some key terms to understand. We have APR, which we've defined earlier. That's annual percentage rate. So that's how much interest you're going to owe on your credit cards, and that's expressed as a percentage. So it may look like on your bill, it may look like 21.99%. That's your interest rate. When you have a balance transfer, you're essentially taking the balance from one credit card to another. So if I have an outstanding balance of $5,000 on credit card A, and I open up credit card B, I can take the balance from A and move it over to B, or shift it or transfer it. I have cash back. Cash back is essentially a rewards opportunity offered by a credit card that essentially says we're going to give you 5% cash back when you use our card at grocery stores. So if I spend $100 at grocery stores, I'm going to get $5 in rewards cash back applied to my account. Whether I can use that for to apply to a future bill, I can take that and put it into my bank account. I can just let it sit there. Oftentimes, some program or some oftentimes there are things like online retail that you can use your credit card points to purchase things. And then you have cash advance. Cash advance is essentially using my credit card, going to an ATM, and withdrawing cash from it. Oftentimes you'll see that cash advance does incur does trigger rather a interest rate. So if I pull $100 out from the ATM using my credit card, I may be charged a separate interest rate on the cash advance, separate of that from my regular interest that I pay on my credit cards. Now, when we're looking at credit cards, oftentimes what we want to consider are things like, what am I going to expense on the card? Is it a card that's going to offer me more rewards for using my credit card at the gas station, right? Or if it's a travel-only card, because I get really good deals on hotels or whatever it may be. What's the interest rate going to be? Is this offering me a higher interest rate than some other credit card company or bank? Do I get an intro offer? Do I get 0% for the first 18 months so I don't pay any interest on revolving debt for the first 18 months? Do I get any cash back? Do I get like 10% at grocery stores, or do I get 4% on all purchases? What rewards rate do I get? And am I going to use this card for any balance transfer reasons? Am I going to open up a new credit card to take from credit card A, move it and transfer it over here, just to save money on interest. When we take a look at debt, there are a couple of different repayment options that we get into. We're going to discuss two primarily, those being the avalanche method and the snowball method. With the former, you are essentially going to tackle the highest interest rate first and then kind of go down from there. So if I have three different debts, one is at 20, one's at 15, and one's at 10, I'm going to attack the 20% debt first, and then 15, and then 10. This is a more mathematical approach. Over time, the math works out that you're such that you're going to be saving money in interest payments. Whereas with the snowball method, you're going to attack the smallest balance first, and then kind of just work your way up. So if I have a $1,000 debt, and then a $3,000 debt, and then a $5,000 debt, I'm going to take care of the $1,000 first, and then the $3,000, and then the $5,000. This is essentially playing on the behavioral aspect of finance, where we want to celebrate the little victories and kind of just start building momentum and build confidence and stuff like that. Now we're going to get into the basics of credit. Why is it so important? So first of all, we're going to address what is my credit score. Credit score is essentially a numerical value that is ranged from 300 all the way to 850 and above. Obviously, as you can see by this graph, the higher your credit score, the better you are looked at when it comes to loans or insurance, even stuff like that. It's important because when we go to apply for a mortgage, or if we want to take a car loan, or even if we want to buy life insurance, all of these things consider your credit score. So if I'm working with a bank for a mortgage, and my credit and everything looks good, my income to debt ratio looks good, and I don't really live beyond my means, and I can afford this mortgage on paper, but my credit score is below average, that's really going to affect the interest rate that I get on the mortgage, aside from the market rates and whatnot. So that's cool. How is my credit score calculated? My credit score is calculated based on 5 factors. What is my payment history like? Do I pay my bills on time? How long have I been paying my debts? How much debt do I have outstanding? Do I have an $800 credit card that I pay off every month and a car loan that I make regular payments towards? Or do I have $25,000 in credit card debt and I don't have a mortgage and I have a car loan that has a high interest rate? What types of credit do I have? Do I only have that car loan? Or do I have student loans? Do I have a car loan? Do I have a mortgage? Some credit cards? Believe it or not, the more diversified your credit, the better it's actually going to reflect on your credit score. How long have I had credit? Have I opened up my first credit card 2 years ago and that's the only credit that I have? Or do I have a car loan that I've had for 4 years and I've had a mortgage for 12, and my student loans I've had for 10 years, and I have a couple credit cards that average about 4 or 5 years? Again, believe it or not, the longer we've had credit, the better it looks on our credit score. And then finally, when was the last time I applied for credit or debt? When was the last time I've had what's called an inquiry? Was the last time I've had an inquiry 3 years ago when I bought my car? Or was it 6 weeks ago when I opened up another credit card? So oftentimes, the longer we go without any of these inquiries, the better it's going to look, because it shows that we're not really relying on debt to fund our lifestyle. And now, just to recap, we went over debt and definitions. We reviewed and discussed student loans. We broadly discussed credit cards. We discussed debt repayment strategies such as the avalanche and the snowball method. And then we also touched on why credit's so important and what it is. And for that, I thank all of you so much for watching. We try to do our best with these webinars and try to make them quick and informative and educational. So if there's any suggestions for additional topics, or if anyone has any questions, please feel free to leave a comment below, and we will see you guys next time. Thank you so much.